So in this video, I want to talk about how important it is to be consistent year after year and how 1% per year can make a big difference. And the best way to show you that is with an example. So let's say you're giving yourself a 25-year time frame with your investments. And let's say you're starting off with the max that you can contribute with the TFSA, and you've never contributed before to your TFSA. So your starting principal is 57,000. So let's say you're investing at the bank in mutual funds, making an average return of 4 to 6%. So let's say you're making 5% with the bank. And let's say you're able to add to your investment, to your savings. Let's say you're able to put, it'll be different from everyone. It'll be different for everyone, but this is just an example just to show you what 1% per year can make as a difference after 25 years, or the impact of 1% per year and the importance of being consistent. So let's say every year you're able to put the maximum allowable of 5,500 for the TFSA. So now if we calculate, after 25 years, if you started off with 57,000 and every year you're putting 5,500 extra of your own money, and you're getting a 5% return every year consistently, compound interest of course. So your 5% interest is making 5% interest the following year. You would end up with $455,000, so almost $500,000 after 25 years. And that's by putting starting off with 57 and putting 5,500 every year. So your total principal, the total amount of money that you put is close to 200,000, and the total interest in 25 years that you made is 261,000. Now let's see what happens if you're making a consistent return of 6% per year. So at 6% after 25 years, you'd be getting around 550,000. So an extra 100,000. So the principal is still the same. You still put the same amount of money, so 194,000. But at this time, the total interest that you've gained in 25 years is 351,000. So at 6%, you'd be getting around 550K after 25 years. So let's see with 7%, you're at 657. So it looks like it's going up by 100K every time. So 1% is affecting your future value by 100K in this scenario after 25 years. Let's put 10%. So at 10%, you'd be at 1,150,000. Let's look at 12%, 1.7 million. So just 2%. From 10 to 12%, you made an extra almost 550,000, almost an extra $500,000 just from 2% extra per year. And your principal is still the same. In 25 years, you've only put 200,000 of your own money, but the interest that you would have collected in 25 years is 1.5 million. So out of the 1.7 million that you'd end up with after 25 years, 1.5 million of it is interest only. And that's just by making 12% per year consistently year after year for 25 years. Now let's try 15%. So at 15% for 25 years, you'd end up with 3 million just by putting 5,500 a year. And remember, this 3 million under TFSA, this 3 million is going to be tax-free. So you can withdraw from it tax-free. It's not going to affect your income taxes as long as it stays in a TFSA and as long as you're not day trading in the TFSA. But if you're making 15% a year, you're not day trading, you're investing. Usually day traders will make 15% per month. Now let's see what happens at 20%. I'm afraid to see what happens at 20%. $8 million at 20% if you're making 20% per year every year for 25 years. So that's obviously, it's easier said than done. You could get some years where you're making 20 or 30 or even 40, but making it consistently for 25 years, that's the hard part. But it's just good to compare, good to see. It's good to have a goal, be ambitious, and know what you're working towards. So you can see the difference here. At 5%, you'd be making $500,000. Even at 6 or 7, you're still in the same range. But as soon as you're making above 10, from 10 to 15, it's just a crazy jump. And look, just 5% more between 15 and 20 gives you an extra $5 million in 25 years, of course. So let's say you don't want to give yourself 25 years. Let's say you give yourself 10 years or even 15 years. So at 20%, if you're making 20% return every year consistently and you're for 15 years, you'd end up with 1.2 million. So your principal, the amount of money that you put yourself is 140,000, but the total interest gained is 1.1 million, giving you a total of close to 1.3 million. So at 20%, if your time frame is only 15 years, given the same starting principal and the same contribution every year of 5,500, so 20%, you'd end up with 1.3 million. Let's see what happens at 15%. You'd end up with 750,000. Let's look at 12%, 500,000 for 12%. So you can see the difference of what a few percentages can make in the long run. And at 10%, you'd be at 400K. So I hope you can realize the importance of time. The earlier you start, the better. The more time you have, the better. And obviously, you don't have to be greedy. As you can see, if you're making between 10 and 20%, that's why my goal is to make between 10 and 20% per year. Because with time and with consistent contribution year after year, your portfolio can grow considerably. But in my opinion, you need to make at least 10% per year. So if we look at our 25-year scenario at 10% per year, you would end up with 1.1 million. Now, and this isn't a TFSA, so it's tax-free. So imagine if you're making, so let's say you're withdrawing from that only 5%, so that's $50,000. So imagine getting $50,000 tax-free every year. If you're withdrawing 10% every year, that's 100,000. So that's really the importance of being consistent year after year. You don't have to be greedy and take big risks. As long as you're in the 10 to 20% range, you're gonna end up with a good portfolio, especially if time is on your side. And that'll be just for your TFSA. If you have an RSP, you're gonna be contributing to your RSP as well. So as you can see, the importance of saving and investing is your key to financial freedom. Starting young, saving, investing, and being consistent in the returns. Not being greedy and erasing everything you worked for. Because you could have like consistent months or even consistent years and then make one bad decision that could erase all those years of hard work and patience. So the thing with dividend investing, so investing in stocks only that pay dividends, the dividends that you're going to be getting are never going to be more than 4% if you're investing in companies. The only way you'll get more than that is if you're investing in the mutual funds that I mentioned in my other videos from Quadravest or Kanui Income Trust. So these mutual funds can pay a 10% dividend, but besides that, investing in Coca-Cola or Enbridge or Procter & Gamble, you're not going to be getting more than 4% per year. So even if it's compound interest, if you're just making 4% per year, your portfolio is not going to grow as fast. It is a great passive way of investing because you don't have to worry about anything. You just keep buying stocks that pay dividends, blue chip stocks, of course. And then at some point when your portfolio is big enough, you can just live off the dividends. But your portfolio needs to be really big in order to live off the dividends. But if you're making 10% or more per year consistently, you don't need that much of your portfolio doesn't have to be that big in order to live off the gains. And also you can live off a portion of the gains and invest the rest so that you can cover for inflation. Because let's say you end up with $1 million portfolio and you just keep living off the gains, your portfolio, your $1 million portfolio is going to stay at 1 million and it loses value because of inflation. So your $1 million is going to be worth less year after year. Your portfolio needs to grow consistently year after year, and you need to withdraw a portion of the gains if you want to live off your investments without decreasing the value of your investments. So this was just a quick video to show you the importance of being consistent year after year in your investment returns and how time can be very valuable if you use it right, and hopefully to encourage young people to invest early so they can retire sooner. So if you have any questions, leave them in the comments below or send me an email directly on my website. So if you're going to open an account with Questrade, use my referral code in the description below the video so you can get between $25 and $250 depending on your initial deposit, of course. All right, thanks for watching.